Another fresh record high, and yet actually we still worry about trade. Is there a danger that we correct quite suddenly?
Well, we haven't seen the impact of the tariffs on earnings yet. And in the second quarter, there was no impact on the earnings, but there were looking forward to what might happen next. And certainly that's what we would expect to see. So the impact on costs, possibly uncertainty about capex, and then thinking about relocation. That's in our conversations with companies, that's what's beginning to come through. So I think it's early stage as far as corporate earnings is concerned. They're very, very strong at the moment, partly because of tax reform. But going into next year, they're likely to be growing less quickly.
What's your take, Jean?
Very much agree with that. I think we characterize this as an uneasy equilibrium where on the one end there's a very strong backdrop, mainly led by the US, reflected in earnings. But at the same time, I think the trade uncertainty is the main driver, or one of the key driver. And paradoxically, I guess this week we got news on the trade front, but at the same time, maybe not as bad as the market expected, and that gives some ease to market, I guess, as we end the week.
Yeah, and if you look actually at the emerging market currencies today, they're also seeing a little bit of a rebound. So are we over the worst for this emerging market contagion?
I think, we see the emerging market space as being driven by idiosyncratic stories. Turkey was a Turkey story. We've been pushing back against a broader contagion to EM story, and we are seeing what we're now, the development in line with this. If the trade noise can be contained, that can leave space for EM to perform better for the rest of the year, and that's our view.
You agree, Lucy?
Well, I think it's dollar debt, external debt is the age-old issue, and it's no different this time round to last time. And so any relief from a weaker dollar is going to help.